Well, there's no doubt that over the last few years, holding cash has been popular with many investors because of the volatility we've been seeing in share markets. The trouble is going forward that the cash rate is getting lower and lower. We've seen the Reserve Bank cut interest rates multiple times over the course of the last year. That is flowing through to lower term deposit rates, which means that the return you'll get from cash, bank deposits, is getting progressively lower. And I think the key going forward, though, for investors is to have a well-diversified portfolio, not overly reliant on an asset like cash, where the returns are getting progressively lower. Well, for investors who are looking for regular income, there are quite a few good alternative investments compared to cash. For example, corporate debt takes on a bit more risk than cash, but not as much as share markets. The yields there are quite attractive, up around 5–6%. Likewise, property, whether it's directly held, and I'm thinking here of commercial property, directly held property, or listed on the share market, again, you're getting yields around 6–7%. Moving along again, infrastructure, similar story, whether listed or unlisted, again, the yields are quite attractive. Even the share market is offering a yield of around 6–6.5% in terms of the dividends that are offered, and when you allow for the franking credits you get from that, which is obviously well above the yield available on term deposits at the moment. So the bottom line is that there are a range of alternatives for investors looking for regular income. They don't have to stay wedded to cash, particularly as those yields get lower and lower. The bottom line for investors is quite simple. Bank term deposit rates are already very low and will get lower over the course of the next few months as the Reserve Bank continues to cut official interest rates to try and stimulate the economy. For investors, this means that they need to look beyond cash to structure their portfolios. For those focused on growing their wealth over time, in other words, accumulating their wealth, it's very important to include growth assets such as shares in a portfolio, not just focus on cash. It won't deliver over long periods of time. For those focused on a pre-retirement situation, they're coming up to retirement, obviously investors in that category don't want volatility. Likewise, for those in retirement, retirees, they want to focus on regular income. For investors in those categories, the best thing to do is consider alternatives that provide good income. For example, alternatives relating to corporate debt, infrastructure, property, and of course investments in the share market that provide good dividends. At the end of the day, my view is that investors really need to get advice from their advisors in relation to structuring their portfolios. The time to be in cash is passing. Those yields are getting lower and lower and are becoming far less attractive.